As we head into the final trading weeks of the year, we're looking ahead to 2025. And joining us now with his 2025 market outlook, we want to bring in Daniel Morris, who's BNP Paribas Asset Management Chief Market Strategist. Daniel, it's great to have you. There's so many directions to go within your outlook. I first just want to focus on the Fed, since that, of course, is the topic du jour as we look ahead to tomorrow's decision. Lots of re-rating, or I guess the narrative changing just in terms of what we should be expecting when it comes to rate cuts. What's your base case heading into the new year?
We think we're going to see a cut in December, and then we'll open up to when we're going to get a second cut at the beginning of the year. And then after that, honestly, we think all bets are on the table. I mean, clearly the Fed has signaled it can't speculate about what might happen, but stuff is going to happen. And I think we need to wait until Trump has taken office. We see what actual policies are implemented. The Fed will do the same. And then once it begins to have a bit more certitude about how policy, at least on the economic front, how the economy itself will develop, then they can reassess where monetary policy needs to go.
Well, let's talk about the path forward for monetary policy, because you seem to agree with this sort of consensus of a soft landing call heading out here for next year. But given the inflationary pressure and the stickiness we have seen in some of the data recently, are there any risks to that call?
Well, I think we're kind of bouncing a bit back between a soft landing outlook that I think most of us had certainly before the election to a no landing outlook, i.e., as I think you're suggesting, maybe inflation doesn't go down the way the Fed projects it to. And alongside that, you don't see the slowdown in economic growth. And then if you want to talk about tail risks, it would be just the opposite. What if growth accelerates? And what if inflation moves back up? Now, I think we're so far quite a ways away from that, but it's more trying to assess and when, more precisely, might we see a soft landing? Is that something that's been pushed off to 2026?
Daniel, is there regional preference? I believe it's still the U.S., even though you are seeing some optimism or reason to believe, or maybe some opportunities, the best way to put that, overseas, especially when it comes to European equities. I guess what should investors then be prepared for in terms of the type of returns or extent of the returns that we're going to see next year, and how it would compare to these past few years?
Well, certainly that's a key question. And when you try to assess what those potential returns are, you take into account both valuations and economic growth. Now, for the most part, you would anticipate probably still above average economic growth in the U.S. for the next year or so. Over the long term, hard to argue that it's not going to trend back to the long run rate, given there's many bigger factors that drive that. Then when we think about markets outside of the U.S., I think you're right to think about what should the next step be? At some point, really, all the good news is likely to be priced into U.S. equities, and perhaps all the bad news priced into, for example, European equities. And at that point, the marginal surprise really should be coming out of Europe. So I think that's what we want to be watching for. We're not quite there yet. We're still overweight, I think, like most U.S. equities, because we think the fundamentals support it. And even if it is a consensus trade, that doesn't necessarily make it the wrong one.
Daniel, is there just flat out too much optimism right now already priced into the U.S. markets?
Well, you could argue a bit of the opposite. If you look at how Russell Value, if you look at how Russell Small Cap has performed really for most of December, it's been on a downtrend, even as you've had NASDAQ move up. And so if you look at the S&P, it looks pretty good, but it's really NASDAQ that's driving it. So I think maybe it's healthy. You've seen a bit of that, a rising tide lifting all boats, everything going up market that we had initially post-election. I think what you're really starting to see now, particularly if you start looking at the sector level, essentially markets implicitly starting to assess, what are the implications for different sectors? It's not all going to be good. You talked about real estate. What does it mean for higher rates, tariffs, and so on? And I think we're going to have to differentiate much more going forward.
Does it all come down to AI then? Because you mentioned some of the pressure in European equities struggling because they don't have the AI trade that exists in the United States. And then the broader indices are really being lifted by those AI names, which is perhaps one of the reasons we've seen the Russell struggling amid macro questions about the Fed's path forward as well. How do you get gains in indices that are not driven by AI?
Well, it's probably a question of what you expect in absolute and besides relative return. So even if you think NASDAQ, at least for a while, is probably going to outperform most other indices, and other indices underperform as long as they're rising to a reasonably good degree, certainly from a diversified portfolio point of view, that's just fine. You probably want to think about kind of NASDAQ-like markets, say, in emerging markets. So, Asia clearly also has several semiconductor angles that I think you can look at. In the medium term, you're right, we are going to have to move beyond the initial semiconductor, data center, energy infrastructure that we're talking about with AI now, and we start to think about as AI is implemented more broadly across companies and other sectors of the economy, where you're going to see the increase in profits.
Daniel, how big of a risk do you see the threat of tariffs? And I just bring that up because of the Bank of America's Fund Manager Survey talking about one of the biggest risks that investors have identified is the threat of tariffs and how that trade war could potentially play out. What's your assessment there?
Well, I think what's so challenging about tariffs is that we appreciate it's not simply a question of, how much tariffs go up, if at all, when, where, and so on. But the reaction of U.S. trading partners. So it becomes a scenario where really you can speculate and come up with numerous scenarios. But as we know, with trying to predict politics or elections, that's a pretty difficult thing to do. So without question, it's a risk. At the same time, it's going to be an opportunity for certain sectors. And you can argue, even if small cap has pulled back a bit to date over the last month, broadly the rise is to some degree perhaps premised on those tariffs. So I think there's two angles, one appreciating the risks and how things might go badly, but at the same time looking at what are the sectors, what are the companies that might benefit from this.